Let me tell you something nobody in this industry will say to your face. You are not too late, and I can prove it with math. Here is the number that changes everything. A 45-year-old who redirects $27,000 a year into index investments, earning the market's historical average of 10%, arrives at year 10 with $430,000. But add a modest side income of $1,000 a month reinvested, and that number climbs past $550,000. Now layer in a real estate asset generating equity and cash flow, and you are looking at a realistic path to $1.2 to $1.5 million by 55. From a standing start. That is not a fantasy. That is arithmetic. And when I am done today, you will know exactly how to build that machine. But first, the lie that may have already cost you years. Every personal finance book opens with the same chart. Two people. One starts investing at 22. One starts at 35. The early starter wins by 3 times. And the message burned into your brain since your first paycheck is this: time is your most important financial asset. If you missed the window, you lost the game. I have spent a lifetime studying money. And that framing is incomplete in a way that is quietly devastating for people in their 40s and 50s. Yes, time matters. I am not disputing arithmetic. But that story was written for people with 40 years. You have 10, and when you have 10 years, the entire game changes. Time is no longer your primary asset. Intensity is concentrated, deliberate, sometimes uncomfortable financial intensity applied across 5 specific pillars simultaneously. The person who started at 22 can be casual. Save 15%, park it in a target date fund, ignore it for 30 years. Casual works when you have decades. You do not have decades. But here is the secret the early starters never tell you. Casual does not produce extraordinary results either. It produces adequate ones. You are not here for adequate, and you are not too late. The people who proved that lived real lives before they started. A school teacher in Ohio, a nurse in Texas, a manufacturing manager in Michigan. I will tell you their exact numbers later in this video because the numbers matter, and they will show you something genuinely remarkable. But before the pillars, I need to reframe the math in a way that changes how you see your position entirely. You have something a 22-year-old does not have. You have income, peak income. The average 45-year-old earns significantly more than the average 25-year-old, often 30 to 50% more. The compound interest charts always assume a flat $100 a month for 40 years. That is not your situation. Your situation is peak earning years, concentrated time, and a skill set built over 2 decades that most people have never thought to monetize. That combination, when deployed with intensity, is more powerful than most people realize. Here is the baseline scenario, done conservatively. A household earning $90,000 achieves a 30% savings rate. That is $27,000 a year going to work. At 10% annual returns over 10 years, the ending portfolio value is approximately $430,000. Not retirement money by itself. But that is only one pillar, and we are building 5. Now let us talk about what the 5 pillars actually are. Pillar 1 is the offense budget, and it is completely different from every budget you have tried and failed before. Most budget advice is purely defensive. Cut the lattes, cancel the subscriptions, stop eating out, and that advice works up to a point. But defensive budgeting has a hard ceiling of 0. You cannot cut your way past nothing. The offense side has no ceiling. The offense budget starts with one question, and it is not the question you expect. Not where can I cut? The question is, what is the maximum amount of money I can direct toward wealth this year? And what structural changes to my life make that number possible? That reframe changes everything. Suddenly it is not about sacrifice. It is about architecture. In virtually every household I have studied, 4 categories consume between 60 and 75% of all spending. Housing, transportation, food, and lifestyle subscriptions, meaning every recurring charge that entered your life quietly and never left. Most people try to optimize everything at once and optimize nothing effectively. The offense budget attacks only those 4, because the leverage there is enormous. One couple reduced housing cost by moving 30 minutes further from the city center. $1,100 a month freed immediately, and it ran automatically from that point forward with no ongoing willpower required. Another family went from 2 car payments to 1, $800 a month, gone. A single woman renegotiated her phone plan, canceled 4 streaming services she rarely used, and found $600 she did not know existed. None of those changes required discipline on a Tuesday afternoon. They required one decision that then repeated automatically. Find the big lever, pull it once, let the savings compound, but here is the piece that makes the offense budget genuinely powerful. The second half is income expansion. And this is where starting late becomes a real advantage. I want you to think carefully about this question. What skill do you have right now today that someone else would pay for directly? Not a vague answer. A specific, deployable, marketable skill built over years of professional experience that your employer currently captures all the value from. Maybe you are a project manager who could consult independently. Maybe you have deep operational knowledge that small businesses in your industry would pay to access. Maybe you write well, sell well, build things well, train people well. You have a library of skills you have never thought of as income-generating assets. The side income goal for the Zero to Hero portfolio is not driving for a rideshare app, building something that can start at $1,000 a month and grow without consuming your evenings entirely. A small consulting practice. A course on what you know, a freelance specialty, something that leverages expertise you already own. Here is why this matters so much mathematically. That school teacher in Ohio earned $102,000 a year. She redirected 38% of her income toward investments. That is roughly $39,000 a year going to work. At 10% over 10 years, that single behavior alone produced approximately $625,000. Combined with her other pillars, she walked out of her classroom at 53 with $2.4 million. No inheritance. No lottery. No side hustle that paid $1 million. Systematic, intense, 10-year execution across 5 pillars. The math does not lie. When you combine the offense budget with income expansion, your savings rate can move from the typical 10 to 15% that most Americans manage to 30, 40, sometimes 50% of total income. And at those savings rates, the 10-year timeline stops being ambitious and starts being conservative. Now, before I give you Pillar 2, I want to give you something right now that most people pay a financial advisor $1,500 to learn. The sequence in which you deploy your money matters nearly as much as the amount you deploy. Most people who get serious about investing just start throwing money at whatever account they already have, usually a brokerage account earning whatever the market gives, or a savings account earning nothing. The correct sequence, which is not complicated but also not widely taught, can add hundreds of thousands of dollars to your outcome simply by putting the same money into the right buckets in the right order. Step 1. Capture every single dollar of employer retirement match. Every dollar. If your employer matches 50% of contributions up to 6% of your salary, and you are not contributing at least 6%, you are declining a 100% return on investment before the market touches a single dollar. That is the best guaranteed return available anywhere in finance. If you are not doing this today, change it today. Step 2. Build a real emergency fund. 3 to 6 months of essential expenses in a high-yield savings account earning 4 to 5%. Untouched. Never invested in anything volatile. This is not an investment. It is the thing that keeps a car repair or a medical bill from forcing you to liquidate market investments at the worst possible moment and convert a temporary paper loss into a permanent real one. People who skip this step blow up years of compounding with a single emergency. Step 3. Maximize every available tax-advantaged account. 401k up to the annual limit. IRA, traditional or Roth, depending on your income and tax situation. HSA if you have a high deductible health plan, which is the most tax-efficient account in the American financial system and still the most underused. The tax savings on these accounts, the deductions today and the tax-free growth over 10 years represent an acceleration that has no equivalent in the taxable world. Quick illustration. A 45-year-old in the 22% federal tax bracket who maximizes a traditional 401k at $23,000 a year saves approximately $5,000 in taxes immediately. That $5,000 reinvested over 10 years at 10% becomes roughly $12,000 of additional portfolio value from taxes alone. Every year you do not do this is $12,000 you leave behind. Step 4. Only after the first 3 are in place do you deploy additional capital into a taxable brokerage account. At this point, you are investing money that has already been sequenced correctly. And that money goes into the investment strategy I am about to describe in Pillar 2. Pillar 2 is the actual investment strategy. and I am going to be direct in a way that will frustrate some of you. The investment industry survives by convincing you that sophisticated equals better. Option strategies, covered calls, leveraged ETFs, sector rotation, dividend aristocrat portfolios, approximately 9,000 flavors of active management. And some of those tools have a place in the right hands with the right expertise. But for the ordinary person building the core of a retirement portfolio on a 10-year timeline, the evidence is not ambiguous. It is overwhelming. Simple, low cost, diversified index investing outperforms the vast majority of active alternatives over any rolling 10-year period. The core zero to hero portfolio is almost embarrassingly simple. 70% total U.S. market index fund, 20% total international index fund, 10% short-term bond fund. As you approach year 8, you begin shifting that allocation toward 40 to 50% bonds to reduce sequence of returns risk in the final approach to your target date. Total expense ratios should be under 0.1% a year. Most funds at Vanguard, Fidelity, and Schwab are already there. That is the portfolio. The sophistication is not in the holdings. It is in the behavior. Because here is the statement that will upset the active traders in the comments. The single most important investment decision you will make over 10 years is not which fund to hold. It is whether you continue holding when the market falls 30 to 40%. And it will fall. I cannot tell you when. But at some point in your 10-year journey, you will open your account and the number will be dramatically smaller than it was. And every instinct in your body will say to stop, to wait, to protect what remains. The investor who earns 8% a year because they hold steady through every crash will massively outperform the investor who earns 12% on paper but sells at every downturn and crystallizes losses. That behavioral gap is real, it is measurable, and it has nothing to do with which fund you picked. Automate your contributions so they happen regardless of how the market feels. Pre-decide your response to a 30% correction before it happens when you are calm. Frame downturns as sales, not disasters. The people who bought more in March of 2020, while the world was convinced the financial system was ending, produced the most extraordinary gains of the decade that followed. Hold the line. It is the most valuable investment strategy available, but the core index portfolio, even with perfect behavioral discipline, is not enough to reach financial independence in 10 years from a standing start. Which brings us to pillar 3, the asymmetric asset. In traditional market investing, your return is essentially capped by the market, 8 to 10% annually over the long term. That is exceptional over 40 years. But when you have 10 years, you benefit enormously from having at least one asset with the potential for returns that exceed market averages, ideally something with cash flow, tax advantages. Both the most accessible asymmetric asset for most people is real estate. And I want to address the obvious objections directly because they are real and you deserve a real answer. Yes, interest rates are higher than they were 3 years ago. In 2021, you could finance a property at 3%. Today, in many markets, you are looking at 6 to 7%. That absolutely changes the math on cash flow in the short term. I will not pretend otherwise. Yes, housing markets in coastal cities and high-demand metros have become genuinely difficult for the ordinary buyer. A duplex in San Francisco or New York or Seattle may be completely out of reach at current prices and rates. And yes, there are meaningful regional differences. Markets in the Southeast, Midwest, and parts of the Sun Belt still offer viable cash flow opportunities. Markets on the coasts often do not at current prices and rates. So let me give you the real framework, not the idealized one. If you are in a market where the numbers work, meaning you can purchase a property where rental income covers the mortgage, taxes, insurance, and a maintenance reserve with something left over, then direct real estate remains an exceptionally powerful asymmetric asset. The combination of forced savings through equity paydown, appreciation, cash flow, and depreciation tax benefits produces a total return that is very difficult to replicate elsewhere. The specific strategy called house hacking, buying a property with 2 to 4 units, living in one, renting the others, can dramatically reduce or eliminate your housing cost. If your current housing payment is $2,000 a month and house hacking brings that to near zero, you have just freed $24,000 a year to redirect into your investment portfolio. Over 10 years, that $24,000 a year at 10% produces approximately $380,000. That is the value of the strategy, even before the property appreciation. But If your market does not support the cash flow math, or you are not in a position to add the complexity of direct landlord responsibilities, or the capital requirements genuinely are not accessible right now, there are real alternatives. Real estate investment trusts traded on public exchanges give you income-producing real estate exposure with the same simplicity as an index fund. Business development companies offer high-yield income with some real estate characteristics. Some geographic markets have emerged specifically because remote buyers have moved away from coastal markets for exactly the reasons you might be considering. The principle is not that real estate is the only asymmetric asset. The principle is that your portfolio needs at least one asset with the potential for returns above market average, with some form of income or tax efficiency attached. What that asset is depends on your market, your capital, your knowledge, and your willingness to manage complexity. The nurse in Texas found her asymmetric asset, not in real estate, but in a small rental duplex 30 minutes from her home in an appreciating secondary market. She paid $182,000 for it in the early years of her 10-year plan, at a time when the numbers supported cash flow. By year 10, it had appreciated to $280,000 and had paid down $61,000 in mortgage principal. That single asset contributed over $159,000 to her net worth, entirely separate from her investment portfolio. Not every asymmetric play works out that cleanly, but the principle of finding one and deploying it intelligently is what separates the person who compresses the timeline from the person who merely meets it. Now, pillar 4. And this is the one that almost nobody teaches because it is not exciting to talk about. Pillar 4 is protection. And it may be the most consequential pillar of all. You can execute all 4 other pillars with extraordinary discipline for years. Then a single unprotected catastrophic event can erase everything. A cancer diagnosis, a long-term disability, a lawsuit, a death without adequate life insurance, leaving dependents with nothing. These are not edge cases. These are the events that derail financial independence journeys every single day. The late starter cannot recover from a catastrophic loss the way a 25-year-old can. The 25-year-old who gets wiped out at 32 has 33 more years to rebuild. The 45-year-old who gets wiped out at 51 has a few years and a retirement that may never materialize. The minimum protection layer is this: adequate term life insurance if anyone depends on your income size to replace your income through the end of your wealth building period. Long-term disability insurance, because the likelihood of experiencing a disabling event before retirement is higher than most people realize, and short-term sick leave does not cover a 3-year recovery from a serious illness. A real estate plan, meaning at minimum a will, a healthcare proxy, and a durable power of attorney, so that a legal complication cannot freeze your assets at the worst possible moment. These are not investments. They are the structure that keeps a crisis from becoming a catastrophe. The wealthiest people I have spent a lifetime observing were not just exceptional builders, they were obsessive protectors. They understood that the asymmetric downside, the risk of permanent catastrophic loss, was the real enemy of long-term wealth. Not market volatility, not taxes. Permanent, unrecoverable loss. Protect the machine you are building. Then go build it. Pillar 5 is accountability and community. I know this sounds soft. The data is not soft. The research on goal pursuit in isolation versus goal pursuit in community is consistent and striking. People who pursue significant long-term goals with no external accountability structure fail at dramatically higher rates than people in community. Not slightly higher rates, dramatically higher. There's a reason the best athletes have coaches, the best businesses have boards, the best recovery programs involve groups, not because the individual lacks intelligence or willpower, but because the financial journey is 10 years long and full of moments when the path of least resistance is to quietly stop, to tell yourself you will restart next month, to move the money back into spending. The person who survives those moments is the person who has built a structure that makes it harder to quit than to continue. Here is the specific action I want you to take before this video ends. Identify one person in your life who is serious about financial improvement and would benefit from mutual accountability. Text them today, not tomorrow, and propose a monthly 30-minute money check-in to review each other's numbers. No judgment. Just shared commitment and shared accountability. That 30-minute monthly conversation may produce more long-term portfolio value than any specific stock pick or tactical reallocation you ever make. Now let me bring all 5 pillars together as a coherent 10-year sequence, because the order in which things happen matters. Year 1 is architecture. You build the offense budget, identify the income expansion vehicle, establish the protection layer, set up the investment sequence, and automate your contributions so they require no ongoing decision-making. You are not expecting dramatic portfolio numbers in year 1. You are building the machine. The machine then runs. Years 2 and 3 are momentum. The income expansion starts producing. Your savings rate climbs past 30%. Your investment accounts begin to show numbers that feel real. The asymmetric asset gets deployed. This is also the period of the first serious test. A market correction, an unexpected expense, a tempting rationalization to pause. The accountability structure matters enormously here. The people who fail the 10-year plan almost always fail it in years 2 or 3, not years 8 or 9. Years 4 through 7 are acceleration. The compounding becomes visible. You start to see months where your investment returns exceed your monthly contribution. The asymmetric asset is generating equity and potentially cash flow. The income expansion is running more smoothly. The destination begins to look real. The manufacturing manager in Michigan, starting at 42, with nothing but a small 401k and a disciplined decision, did the math in year 6, and found himself at $712,000 in total net worth. He had started at essentially zero. He called it the moment the disbelief became belief, not hope. Actual belief grounded in actual numbers. He reached $1.8 million at 52. Years 8 through 10 are the approach. You shift gradually from aggressive accumulation to preservation. Bond allocation increases. You begin modeling your actual retirement income scenario with real numbers built from real history. You start to see the specific month when work becomes optional, not a fantasy, a projected date with a margin of safety around it. And then one day, you arrive at the number. Not because something lucky happened, because you built a machine and let it run. How much is the number? The most widely validated framework in retirement research is the 4% rule. At a 4% annual withdrawal rate, a diversified portfolio can sustain withdrawals indefinitely without depleting principal. That means $1 million supports $40,000 a year. $1.5 million supports $60,000. $2 million supports $80,000. $2.5 million supports $100,000. Your number depends on your anticipated expenses, your Social Security income, whether you plan to work part-time in retirement, and your personal risk tolerance. But the framework is clear. For most people reading this, the target is somewhere between $1 million and $2.5 million. And the math, with genuine intensity across 5 pillars, makes that achievable in 10 years for a household earning between $75,000 and $150,000 annually. Let me show you the 3 real cases one final time with their actual numbers. The school teacher in Ohio. Starting point at age 43, $68,000 in a 401k. Annual income, $102,000. Savings rate achieved, 38%. Side income developed, $22,000 annually from tutoring and curriculum consulting, eventually scaled to an online course. Asymmetric asset, a duplex purchased in year 3, generating $1,200 per month in rental income by year 6. Ending portfolio at 53, $2.4 million, the nurse in Texas. Starting point at age 48, $47,000 in savings. Annual income, $81,000. Savings rate achieved 44%, achieved by eliminating 1 car, house hacking her primary residence, and eventually earning an additional $14,000 a year from telehealth weekend shifts. Ending portfolio at 58, $1.6 million, plus $230,000 in real estate equity, the manufacturing manager in Michigan. Starting point at 42, $31,000 in a 401k, essentially zero in other savings. Annual income, $94,000. Saving 1% year 1, climbing to 42% by year 4 as the consulting practice grew. Consulting practice revenue, $40,000 annually by year 4, directed entirely to investment accounts. Ending portfolio at 52, $1.8 million, 3 different people, 3 different starting points, 3 completely different income levels and life circumstances. 1 common denominator. They did not wait for conditions to be perfect. They started with what they had, built the machine, and let 10 years do what 10 years can do when intensity is applied deliberately. None of them found this easy. All of them found it worth it. Now I want to ask you something direct. and I want you to answer it honestly, just for yourself. What is the cost of another year of waiting? If you are 45 today and you start this plan in 1 year, you arrive at your destination at 56 instead of 55. But the real cost is not the 1 year. The real cost is the $43,000 in market returns that year would have produced on a $500,000 portfolio. The real cost is the 12 months of employer match you did not capture. The real cost is the compounding that did not start on money that was sitting in a checking account earning 1%. The cost of waiting 1 year, calculated honestly, is often $70,000 to $100,000. For someone starting with less, it is proportionally less, but it is never zero. It is never free. Waiting always costs something real. And here is what I know about the person watching this right now. You have been waiting, not because you lack intelligence, not because you are lazy, because the noise around money is deafening. The options feel overwhelming. The financial industry benefits from your confusion. And somewhere along the way, you started to believe the whisper that said the boat had already left. The boat has not left, but it will not wait indefinitely. And the longer it waits, the more expensive the ticket becomes. Here is the one thing I want you to do right now. Not after this video ends. Right now, while the ideas are still vivid and the resolve is still present. Pick one action, just one. The most immediately executable action from what you learned today. Open the investment account. Change your 401k contribution to capture the full employer match. Transfer 1 month of emergency fund savings to a high-yield account. Text the accountability partner. Look up the 401k contribution form on your employer's HR portal and fill it out. One irreversible action. Before you open another app, before you check your messages, before you tell yourself you will do it later. That one action is not the 10-year journey, it is the ignition. And once you have turned the ignition, something shifts. The plan moves from abstract to real. The discipline becomes easier because you have something to protect. The accountability becomes natural because you have something to report. 10 years from now, you will be 10 years older. That is not optional. The only question is whether you arrive at that day with financial freedom or still wishing you had started. If this video shifted something for you, share it. Send it to the person in your life who is 47 and convinced it is too late. Send it to the sibling who has been saying they will start saving next year for the past 6 years. Send it to the person who has every tool and none of the belief to stew bear if you want to continue this journey. The next video goes deep into tax efficiency strategy, specifically how to structure withdrawals across different account types to minimize the tax drag on your portfolio in both the accumulation and the withdrawal phase. It is the information that most CPAs charge $200 an hour to explain, and it will be completely free here. Do not miss it and start today. That is all the wisdom I have for you. Use it wisely.